August 1929. The New York Stock Exchange is undergoing rapid expansion. Investors are buying stocks left and right. Millions of dollars are traded every day. However, most of this investing is coming from wild speculation. People are thinking that they can make a fortune from the stock market, but they don't realize how volatile it is. People all over the streets, from high-profile businessmen to shoe shiners, are giving advice on what to invest in. This is causing the market to become overvalued and causing it to rise, even as the economy surrounding it could not support it. Production was already declining, construction was coming to a halt, and automobile sales went down. Consumers built up massive debts due to easy credit, and unemployment started to rise. All of this is what led to the upcoming crash. Stock prices slowly began to fall in September and early October. Investors began to sell their shares one by one. As more investors sold their shares, more people became worried and sold theirs too. On October 24th, the market opened at 11% lower, and a record 12,894,650 shares were traded. So much trading was going on that the reported prices on the ticker became inaccurate, which served only to increase panic. To try and contain the madness, several leading Wall Street bankers purchased a number of stocks well above the price they were worth. This was able to stabilize the market, for now. The following Monday, prices lowered again, this time even more than before. It lowered to a staggering 13%. Without any help from bankers now, the market plummeted. On the next day, Tuesday the 29th, about 16 million shares were traded. Some stocks even had no buyers at any price. These 2 days were known as Black Monday and Black Tuesday. Over $30 billion was lost during this time, which would equal about $415 billion today. After Black Tuesday, stock prices had nowhere to go but up. There was a little bit of recovery during the next few weeks, but with the Great Depression coming closer, prices stayed low. In 1932 and 1933, stock prices finally hit the bottom. They were down from about 80% from their highs in 1929. People's demands for goods dropped because they were poor from losing money in the stock market. There was also chaos in the banking system. Banks could not collect loans from stock market investors since the investors had just lost it all. Banks had also invested depositors' money into the stock market. As word got out, many people rushed to withdraw their money from their savings account, but this money was no longer there. Hundreds of banks began failing as they could not get the funds from the Federal Reserve System. After banks had failed, people lost their money, and the rest of the economy was spiraling down. The period of the Roaring Twenties came to a grinding halt. The stock market crash may not have been the direct cause of the Great Depression, but it certainly did devastate the economy. And even saying that would be an understatement. Many people lost all of their savings, numerous companies were ruined, and faith in banks was destroyed. To this day, some historians still argue what the exact causes of the crash were, and just how much of an impact it had on the upcoming depression. However, most people view the stock market crash as a signal that the Roaring Twenties was over.